This is Blondel Pinnock, and I will be presenting Underwriting a New Markets Tax Credit Opportunity through AreaProbe. I am a consultant with BP Capital Strategies. I am the president and founder of that company, and I started the company focused on social impact investing, including opportunity zones and new markets tax credits. In addition to change managements for CDFIs, nonprofits, and business entities. I started my career as a lawyer and then transitioned into banking, where I worked for Bank of America in their community development lending group as a construction real estate lender. And then I worked for Carver Federal Savings Bank a little over 10 years, where I was chief lending officer for the bank and also in charge of the bank's new markets tax credit program. All right. With this webinar today, learning objectives are going to be be able to explain the background of new markets tax credit program, to describe the typical investment structures of new markets tax credits, to recognize the different players and entities that are involved in these structures, to identify businesses or projects that would qualify for new markets, and to summarize the benefits for your business or projects and how it would receive new markets and how it would work in an actual project. All right. So briefly, I'm going to go through just the history of new markets tax credit programs. Many of you may know that it was created by Congress as part of the Community Renewal Tax Relief Act of 2000. It's codified in Section 45D of the Internal Revenue Code. It is administered by the CDFI Fund, Community Development Financial Institutions Fund. It has bipartisan support for permanent expansion, but it is not a permanent program as of yet. It was most recently extended through 2019 at $3.5 billion. And as many of you know, there was just a recent allocation or award that was made just a few weeks ago, and it was $3.5 billion. That was that award for 2019 in new markets tax credits. And for the most part, as of today, there's been $57.5 billion in new markets tax credits allocations that have been made throughout the country since the inception of the program. The federal government authorizes an annual credit authority for new markets. The CDFI Fund, as I mentioned before, oversees the program and awards the allocations to community development entities, otherwise known as CDEs. CDEs are the ones that have the power to determine what projects will be funded. Different CDEs may have a different area of focus. A CDE could be focused on funding in food deserts. A CDE could also be focused on funding charter schools or healthcare facilities. So it's the CDE that determines how and where their funds would be, the allocations, would be used. Okay, awarded projects will receive favorable low market financing with the opportunity of a forgivable loan at the end of the compliance period. And investors will receive 39% tax credit based on the total qualified equity investment that will be made. And we'll learn a little bit more of this as we go through the slides. All right, so the benefits of new markets tax credit programs. So for an investor, a private investor, and what new markets really does allow, it allows private capital to come into highly distressed neighborhoods and help to develop businesses that would otherwise not be able to get. A key component of new markets tax credit is but for. All right, there must be a but for cause in allowing a project to be done. And essentially what that's saying is that if this project could be done on its own with regular financing, bank financing, or investor financing, then there truly would not be a need for new markets. New markets gets to the heart of a project that would have a difficult time being able to get financing. So some of the benefits, it allows investors to receive 39% of federal income tax credit based on the amount of investments. That includes loans and equities into the project. The compliance period, as I mentioned before, is a 7-year compliance period. So the investor typically receives 5% of tax credits years 1 through 3 and 6% of tax credits years 4 through 7. The benefit also runs to projects and businesses. It allows a project to receive a significant benefit at the end of the 7-year compliance period in the form of equity. And that's for a leveraged transaction. For an unleveraged transaction, it allows an interest-only loan to a project for 7 years. That would normally not happen in a regular standard bank financing. All right. As many of you know, New Markets Tax Credits has its own language, and it is the alphabet soup. And you probably have seen some of these or heard of some of these, but you will see on occasion, or normally you'll see CDE or Community Development Entity. You'll see sub-all or substantially all. You will see Qualified Equity Investments or QEI, Qualified Low-Income Investments, QUILICI, and Qualified Active Low-Income Community Business, Qualic B. So these are the normal acronyms that you will see, and this is what it applies to. All right, so going straight to financing structures. I know some of you have probably seen these very complicated, complex charts when it comes to new markets financing structures for projects. There are a lot of boxes, there are a lot of arrows, but simply put, there are two types of projects or financing structures that exist for new markets tax credit projects. So the first is the unleveraged or the direct funding. And that is the simplest, cleanest way to finance a new markets tax credit project. And all it is direct funding from the investor, the new markets tax credit investor, to the CDE, the community development entity. The community development entity then makes a loan. It could also be equity, but it typically is a loan that is going to make to the low-income business. And that loan will be interest only for a 7-year period. Now, the advantages of doing an unleveraged or direct transaction is that it is very simple because it's really structured as a loan, and it has lower transaction cost. Because as I noted, and you will see this as we go forward, when we start to get to more complex new markets tax credit financing structures, it can become very overburdened and overworked with attorneys and with consultants, and there can be a lot of fees that result that come as a result of that. The second type of financing is leverage models. IRS Rev Rule 2003-20 approved a leverage structuring, right? And it leverages additional new markets tax credit equity. It provides an additional layer or an upper tier to a financing structure. It provides funding to a CDE through a qualified equity investment, and it provides debt financing that does not interfere with the new markets tax credit investor receiving its tax credits. And we'll get into a little more detail as we move forward. Okay, so here's an example of a simple direct new markets tax credit structure. That's the unleveraged structure or the direct financing. So in this instance, a developer wants to build a $3.3 million grocery store as part of the mixed-use development in a new markets designated area. The developer receives an allocation of $3 million from a locally based bank CDE. This generates tax credits of 39% or $1.1 million over a 7-year compliance period. And that tax credit will run to the investor who's invested in this project. The developer and the Qualic B, the business, will receive approximately $3 million from the new markets tax credit investor, which will flow through the CDE to assist with the project financing in the form of a low interest only direct loan. At the end of the 7-year compliance period, the $3 million is typically repaid to the CDE lender through refinancing. think the benefit of these type of transactions and what the ultimate goal is to help businesses. This program was intended to be a job creator. So you're helping businesses, and typically, if you came to a bank, most businesses wouldn't be getting a 7-year loan. So New Markets does allow for a much longer time horizon for many of these businesses and projects, which is needed in these highly distressed neighborhoods. And a loan at an interest only lower financing hurdle is also beneficial to a number of the projects if they're just really trying to get started and get their and try to develop market share in many of these emerging or marginalized markets. Okay. Going to slide 10, you will see an example, and when we're starting to get to the boxes, of an unleveraged or direct investment New Markets tax credit structure. So the same example that I gave you earlier, essentially here you see on the top level the New Markets tax credit investor, and they're making an equity investment or qualified equity investment, QEI, to the community development entity, the CDE. That CDE, in turn, is making a loan, or as we know it, a QLICI, Qualified Low Income Community Investment, to the business. The business is known as the QUALIC B. The QUALIC B, in turn, is going to make loan payments. So that interest-only payments is going to make it to the CDE. And the credits that are generated, that 1.7, I don't know if you see that 1.17, those credits are going to run up to the New Markets tax credit investor over the 7-year period. So that's very simple. And that was done usually in the early phases, a lot of the early phases of the New Markets tax credit program. A lot of institutions did use the credits in this way. It was simple. It allowed for a lot of CDE banks, one of which was Carver, to be able to take part in this program without a lot of brain damage and a lot of expense. Next is the leverage investment structure. So Rev Rule 2003-20 permits leverage financing structure. It permits splitting of economic and tax benefits of a New Markets transaction. So a lender receives the economic benefits of its loan, and the investor receives a tax credit on its investments. The loan must be unsecured at the upper tier level, and we'll get into that a little further as we move through the slides. All right, so here's an example of the arrows and the boxes, as we've mentioned before, that just gives you a sense of what a typical leverage loan structure looks like. And this is simple, believe it or not. But this just shows the investor that's to the left of your screen making an investment into the upper tier level, which is the investment fund. And then you see a lender that's making a loan also into that upper tier investment. Together, that amount is going to be funneled through the CDE as an investment, a QEI. That CDE will then make a loan to the QUALIC B. And those loans will definitely be structured in an A note and a B note, which we will talk about very shortly. All right. So non-recourse debt. So debt is non-recourse and does not contain a conversion or a participation feature. So that's the when there is a debt piece, because as you saw on that previous slide, there is a loan component that's part of the leverage model. Unsecured loan. The loan is secured only by the investment LLC interest in the CDE. The assets of the CDE or QUALIC B do not secure the loan. So very quickly, what this means is if the lender on that top level, if I go back to that diagram, that lender who's making the loan, they don't have a secured interest in this real estate here at the bottom, the QUALIC B. They're not able to secure it as collateral. There is, in fact, a standstill agreement. that does not allow that, because in the event that there is a problem with the project, what you don't want to happen is for the lender to be able to foreclose on this project and cause an issue with the recapture of the new markets tax credits. Because remember, it is a 7-year time horizon, and those credits have to be in the project for that 7-year time period. So any lender that's part of the leverage model, they have to be confident to lend to this fund and not have any security or collateral at the qualic B level. All right. So here I give an example of a project that was done using the leverage model that I actually did work on. So the project is known as 950 Westchester Avenue. It's located in the Bronx. It was a allocation of $10.5 million. The qualic B was known as Westchester Housing Development Fund. The CDE was Carver Community Development Corporation. So Carver had the new markets tax credit allocation. The investor was U.S. Bank Community Development Corporation. And the neighborhood is the Melrose section of the Bronx. The project is a mixed-use project, 111 units of low-income rental housing, 26,000 square feet of community facility space, 9,500 square feet of retail and parking. The project involved the build-out of the commercial and community facility space. The project created 63 new permanent jobs and retained 30 jobs, with 24 construction full-time equivalent jobs. Okay. The transaction structure. The transaction was structured as a leveraged new markets tax credit structure and expected a newly formed entity, the investment fund, to be created and combine debt and equity to make a $10.5 million qualified equity investment into one CDE. So in your slide, after your slides, there is a handout that shows, let's see here. Okay. There is a handout that has the structure of these loans and a transaction diagram for 950 Westchester. Let me see if I can pull that up for your use. Hold on for a second. All right. So if you go to PDF, there's a handout section there. I'm trying to. Yeah, I don't know if I can actually get to that. Okay, I just did. All right. So hopefully you can see that I have the Westchester Avenue project, as I was mentioning earlier. And with this write-up, this is a typical write-up that one would find or that one should be thinking about when thinking about doing a new markets tax credit project. What this project summary does is it gives an overview of the project itself. It gives some highlights about the community facility space and retail space. The important piece here is section B, which is the local community impact. In every project that you're doing with regards to new markets tax credits, the community impact is a critical component of the underwriting of the transaction. You have to be able to show that where the project is located, that it is located in a new markets designated census tract. You want to talk about the poverty rates and the area median income, as well as the employment rate. Here we talk about the uses within that space. So what type of community uses would be there and how it will be benefiting the low-income community. We also mentioned in C the high community support. So it was important to show that this particular project had the support of HDC. It had the support of the city through tax credits and a portion, as well as tax-exempt bonds, income housing tax credits for the upper portion of the building. Now, when we get to the transaction structure and the unwind process, I think here is a chart that we use to diagram what was actually happening. So if you look at the top level, you'll see that there is a leveraged lender here. This lender is providing a $7.6 million leverage loan, interest and principal payments. Then you see there's a new markets tax credit equity investor. That investor is providing an investment amount of $2.9 million. Both of those combined will go into the investment fund, which is that second level that you see. That total in the investment fund amounts to a qualified equity investment of $10.5 million. That $10.5 million equity investment is then flows through the community development entity, or the CDE. All right. The CDE will do one of two things. A portion of that fee will go to the allocatee. In this case, it was a CDE fee of $500,000 that went, which is typical. And then the remainder would be structured, as you see here, into two loans. Loan A for $7.6 million, which originally came from the leveraged lender. And then loan B, which equates to the equity that came in from the new markets tax credit equity investor. Both those will flow as two separate loans to the qualified low income community business, or the QUALIC B. In addition, you have the developer on the left that is also making an equity contribution to that project. Now, if you scroll down further, you'll see the sources and uses of that investment and of that project. So here you have the senior leverage loan and what percentage it makes up, the 7.6. You have the new markets tax credit equity of 2.8. That gives you the $10.5 million. That $10.5 million goes to the investment fund, as we mentioned. That investment fund then flows to the CDE, or community development entity, who will in turn make two loans. So like we indicated, there's a senior loan of $7.6 million. And then there is a loan B, a subordinate loan, that equates to the equity that was given on the upper tier. We have here the allocation of the CDE fee that goes to the CDE. And again, that totals your whole $10.5 million. That senior note is paid up through that transaction. I'm going to go up again. Is paid up through that transaction, as you can see here, by the business. So it goes to the CDE, and it flows up to the investment fund, and then it flows up to the lender, who gets the payment of their loan over that 7-year period. With the equity amount is really paid at a very nominal fee over the time, because with respect to the investor in a new markets tax credit program, they are getting the benefit of that full investment level, $10.5 million, for a $2.9 million investment. So they get the value of 39% on the investment fund value, or the QEI, of $10.5 million for their $2.9 million. So that is their benefit that they get. And that is why the leverage transaction is much more desirable by investors than the direct equity model, because it does provide much more in the way of equity investment for the investor in this project than the direct model. As you look further down, you see the sources of the loans of the loan funds, and then you see the sources of the project, specifically what those dollars are going to be used for in this breakdown. I'm just trying to scroll down a little further, but okay, there we go. Then you see specifically the uses of the funds for this project. So a portion will be used to pay down a construction loan. There's reimbursement of tenant improvement and other costs, which are typical. Then you have soft costs of compliance fees, lender fees, and legal and accounting fees, which you see here. And as you can see, it's 5%, which is quite considerable. But it is typical for these transactions because of their complexity. You also see here a lease-up reserves. It's generally a reserves that's established for the project over the 7-year period. And then, of course, you have construction contingency here that equates to the amount that's being funded. Okay. All right. So the A loan. So I mentioned that earlier. And the A loan, it reflects the terms of the leverage lending source. The terms are driven by deal specifics. So the lender requirements, the financial projections, and residual analysis. If it's a conventional loan, market rate, interest, or government agency loan, perhaps it could be below market interest rate. Okay. It may be interest only for the first 7 years, and the term of at least 7 years is required in that A loan. And at the end of the 7 years, that loan is repaid or refinanced. Okay. The B loan, which we mentioned, it's usually interest only for 7 years. It may have a longer term. It could be 40 years. It depends on the transaction details. But again, it's a longer term in that you want that loan amount to be, repayment amount to be as nominal as possible. It's going to be below market rate of interest. And more importantly, the debt may be subject to cancellation after the investor exits this project. So what tends to happen with the B note is at the end of the 7-year compliance period, there is a put option. And 9 times out of 10, I think in every transaction I've seen, for a nominal amount, usually $1,000, there is a put for that B note. And that B note then will cancel, and the developer or the Qualic B is able to have that, to get that loan for nothing. They basically that loan winds up converting to equity into their project, and they are not responsible for having to repay that B note. So that is the other benefit and beauty of a leverage model. So it benefits the investor in that they get much more value for their bargain with the investment fund. And it also benefits the developer because at the end of the 7-year period, that B note generally does not have to be repaid by the developer. Okay. Guarantees to investors. So Qualic B guarantees are typical loan guarantees. There's a new markets tax credit compliant guarantee. So essentially the business that's being financed has to agree to remain in compliance over the 7-year period, and it has to maintain its standing as a Qualic B. The CDE, community development entity, the one that has received the allocation, they have to continue to be certified as a CDE during that 7-year period. They have to ensure that they're using substantially all, or at least 85% of the qualified equity investment for qualified investments. So they have to utilize the funds that come down from the investment fund, at least 85% of it. And they have to meet the qualified investment requirements throughout the 7-year compliance period. Okay. So the pros and cons of leverage structures. So pricing. New Markets Tax Credit investor receives credit on cash investments plus the amount of the qualified equity investment financed by debt. All right. So that's essentially what the model that we showed with the handout is, that a combination of both the equity and the loan that's being made, the investor gets the benefit of 39% of that total amount, even though they may only be putting in $2.9 million of the 10 and a half. The difficulties, however, is the potential in obtaining an unsecured loan from lenders in terms that fit, and potential complications on multi-tier funding. So as I mentioned before, if you are a lender in that upper tier and you're making a loan into the investment fund, you have to be comfortable with being able to stand still or not have any collateral interest in that property. There are not many lenders who have that level of comfortability. What we normally find is that the investor may also usually has a lending arm, and they are doing both pieces of the transactions. Like one area of the institution is the investing side, and there's one area that's doing the lending. And that way they have a level of comfortability with regards to that. But it is very hard to have a one-off lender who has no relation to the project to be able to do that. Because lenders are generally not in the business of providing unsecured financing for projects. Okay. The other piece here that could be a con are the transaction costs. As I indicated before, there's origination fees. So there are the origination fees, like typically we saw 5%. There are also ongoing asset management fees that go to the CDE. As I indicated, the CDE has to remain in compliance during a 7-year period. So they receive fees every year, and it could be, and again, could be negotiated. So the fees could go from 10, 15, 20, 25 basis points. It really depends on how you negotiate what that is. There's a reserve requirement for the new markets tax credit investor. So as we showed in the diagram, that there was a reserve that was set up with those funds for that particular project. And I think the most important fees here that is not mentioned is the legal fees and accounting. So there are definitely going to be a lot in the way of legal fees and accounting fees, because accountants have to set up their Proforma over the 7-year period, and then legally being able to memorialize all of these transactions at these different levels requires a certain level of expertise in your legal team. And that is where a lot of expenses generally goes with regards to these projects. Okay. Exit strategies. So we mentioned briefly some of the exit strategies. For example, with the direct funding, the unleveraged transactions, the exit is usually a repay or refinance of that loan, that interest-only loan, at the end of year 7. Another exit strategy is a put option that may be in place with dedicated reserves during the initial structuring, so the Qualic B can buy out the new markets tax credit investor interest. So that's the put option we discussed when it comes to the B note. Debt may be canceled after investor exits. So after the investor is out of the transaction, after year 7, the investor may just cancel the debt that it has as part of the exit strategy for that particular transaction. So that is all that I have right now, but I'm sure that there are a number of questions with regards to this, because it is pretty complicated, and it's one of those programs that you truly don't get to know until you are actually doing a transaction. I will say that the example that I gave was a very simple leverage transaction. But what you will tend to find, particularly now, is that there are several CDEs that may be involved in a transaction. So you can start to see a model that has several boxes that has several CDEs, and in many cases, some of those CDEs have their own counsel, and that's where things start to get a little dicey.